Well, I think private equity evolved tremendously over the past 20 years and has seen a very strong growth as an asset class due to attractive risk return profile, but obviously also due to the demand by investors of handling more returns which are uncorrelated to other returns that they are seeing. So this is a very strong success story, private equity in general, but there is clearly also a role that innovation plays in our industry. One of these largest innovations that we have seen over the past 10 years or so is the evolvement of a secondary market and a kind of a trading of what has been before relatively illiquid assets. And obviously, comprehensible pricing is absolutely key for a functioning secondary market, as you would have seen on the stock exchange as well. But pricing is much more complex in private equity, in private assets, and much less reliable than stock market prices. So just relying on the face value of a GP's valuation is not enough anymore. Large secondary LPs have told me that they're still, completely only focusing on the discount that they're getting when they buy a certain LP stake, a discount to the net asset value that has been shown by a GP. But I think there's much more into that, and I will guess that we will see much more innovation and much more scrutiny of GP's valuations in the period going forward. Well, I think it's extremely important in my experience as a GP that there is a clear strategy and that this strategy is also being transparent, about the degree of latitude that is inhibiting is inherent in every valuation. The strategy should also be documented and should be discussed with limited partners on an ongoing basis and might be changed throughout the fund's lifetime, which often is a decade. I think what is very important from my experience when I see and when I talk to my LPs is that LPs need to learn how a GP then implements that strategy across the fund's lifetime, but more important, also across cycles, because valuation can change and valuation policies can change as well. And LPs need to get a hand around the GP's valuation in order to fully understand, is this a rather bearish valuation? Is this rather a bullish valuation that the GP is putting in his books at every quarter? I think if a GP buys at a discount to what he perceives as market value, it is quite an important question in how to consummate such a discount. Is it a discount, that is based on the quality of the asset? Then it's probably also justified, and hence there is no discount, what we would say. Or is a discount when the GP buys an asset really justified because it's more due to the transaction dynamics rather than the quality of the asset? And then the question is, do you increase the value of the asset straight away to a mark to market, or do you consummate this discount over time? And we have seen two very different landscapes in that respect. Most people in the secondary world would increase the discount that they're getting to net asset value when they buy an LP stake straight away. Most GPs would probably consummate the discount over time, and that has an inherently different view, or gives an inherently different view on the quality of the asset and the valuation that an LP has. I think in general, on a more practical note, I believe that the industry should increase the viability of valuations by offering LPs valuation in a very speedy way, in a very clear way, and not 3-4 months after the time of the balance sheet. So I think that's also a factor that plays into the world, because speedy information is increasingly needed and will help fuel what I said before, namely the viability of a secondary market and the trading, and thereby reducing the illiquidity premium that private equity probably gets in the overall asset landscape. Well, I think that goes back to the mentioning at the beginning. LPs need to place quite a certain scrutiny and need to understand how valuations are being put together by their GPs. I think, taking a step back, valuations face two fundamental problems next to being synthetic anyways before an asset is realized. Multiples of listed companies, which are quite often the basis on a valuation that the GP is producing, are used to value private companies in a view that is probably less and less reliable. I think many market participants would agree that stock market prices are today more and more driven by monetary policies. I quote the asset price inflation that we're currently seeing, and also imbalances in the stock market universe. Less companies being listed anyways. So these problems need to be taken account. And I think as an industry, we need to offer more than just marking our assets based on the multiples of listed comparable companies. I also think that the problem of a majority or a control premium needs to be discussed further on. I think everybody would agree that if you hold the majority of an asset, if you have the control over an asset, you would list that higher up in terms of valuation than if you're just a minority investor. But there is no real industry-wide accepted methodology to determine that premium in such a valuation. On the other hand, there is an illiquidity discount that people are discussing as well, such as when you have a private market asset versus a public market asset. The private market asset is less liquid, hence there is a valuation discount on that. So these problems give a very high degree of latitude to the GP and need to be understood by all the partners in a fund in order to determine a true and fair valuation in a portfolio. I also think that the benchmark is quite important. I mean, what is the performance of a GP? How do you benchmark the performance of a GP? Do you benchmark it in terms of a time series versus the valuation that the GP has done in the past? Do you benchmark it to other GPs that are in your portfolio as an LP that might be very heterogeneous strategies with different risk profiles, so very difficult to justify from a more theoretical point of view? Or is it comparable asset classes, as many people do, namely comparing with certain elaborate and sophisticated models the performance of a private markets portfolio to the performance of a public market portfolio? At the end of the day, it is very clear, and it remains a truth since long time. You don't know the valuation of an asset until it has been sold. I think this is a particularly difficult task. And I think it's also a task that private equity hasn't been very strong at over the past 30 years. How to integrate risk into a valuation on different levels, being it at acquisition of an asset, be it throughout the lifetime of an asset, or then reporting to their LPs. I think that the whole industry is still very much concentrated on cash based on history, when returns were so strong that nobody really cared about IRR or risk. The risk premium just outweighed the risk concerns, and everybody was making money. I think in the future, as more and more money is coming into the asset class, returns will reduce to a certain extent, and people will have to think about, hey, how do we include risk into a certain valuation? I think there is still a lot of thoughts that need to be put into place, and also methodologies that need to be accepted and implemented by GPs. I think that's also one of the things that I said before in terms of innovation. I think with more and more capital in the asset class, there will be a reduction of returns for standard investment strategies. So either you accept as a GP and you start to innovate the offering, either the investment strategy or the approach to origination or portfolio management, or you will face a problem in the future. And I think ESG is one particular focus of the whole investment community that will be here to stay and to increase. So I think first and foremost, ESG can be seen from a risk point of view. The higher the underperformance in an ESG measure in a certain company or a certain portfolio, the higher the risk of negative cash flows, thereby impacting valuation, respectively commanding a discount. But I think moving on into the next decade, I also believe that sound ESG performance should not only be viewed from a risk point of view, it should also be viewed as a premium. Because sound ESG policies do command a premium in the private markets today as well, and it will increase so. So I think there is a clear need and a drive for the industry to develop and establish methodologies to take ESG measures into account.